And joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market performance. Jason, thanks so much for your time this afternoon. Now, the Fed minutes were an interesting read, right? While a narrow majority favored more rate cuts, some governors argued for holding rate steady. How are you reading that? A really difficult balancing act for the Fed, of course, where hiring is slowing, but those inflation risks still remain, especially as we await the tariff impact.
Absolutely. I think it goes back to, I sound like a broken record here, but yeah, this is the issue of the dual mandate of the Fed. While yes, we do need to just bear in mind that there is an inflationary impact to tariffs, but that will be a one-off. But at the same time, the reality is, if we look at all the inflation metrics across the board in the US, it still is above the Fed's target. There is this weakening in the job market, and obviously with the government shutdown in the US, you are starting to see a large swath of government employees not receiving their salaries. So yes, that will provide a little bit more weakness on the consumer side. But yeah, I mean, overall, they are pretty much stuck between a rock and a hard place. However, it does seem that the direction of travel is towards more rate cuts, even though there is some resistance across the board in the Fed. But it does look like a weaker labor market appears to be front of mind rather than slightly elevated inflation expectations.
Yeah, and I can imagine how difficult it will probably be for policymakers moving forward, especially as we are not seeing an end to that shutdown, meaning the policymakers might not even get to see a glimpse or a view on how the labor market is actually performing.
Correct. I think we just need to bear in mind that we're looking at a couple 100,000 workers. That sounds like a lot, but in the context of the US economy, it is a small portion of the job market. But yeah, look, it's incrementally not positive news for the market. And yeah, also we got to look at to what extent will Trump use this as an opportunity to start firing workers in various programs across the board within the government. So correct. This it's not just an economic issue. It's very much a political question around this.
Yeah. Now, over in good news, right? TSMC out with an update topping sales estimates. This comes as no surprise, right? The demand of chips continues to grow. TSMC, of course, the main chip supplier to companies like AMD, like NVIDIA.
Correct. Yes, I think TSMC is in the fortunate position with this. With this capex spend in the AI sector, they are almost the first beneficiary of it, right? So whether or not these hyperscalers can turn a profit and generate revenue off the various AI projects, that at this point up until now is almost irrelevant for TSMC. But it goes to show the demand within the sector at the moment is just not slowing down.
And just on that, there's been a growing concern, Jason, around an AI bubble. Both the IMF and the Bank of England recently sounding the alarm on that. What do you make of this? Is the AI boom real progress, or are markets getting ahead of themselves here?
I think if we look at from a valuation perspective, it very much seems like the market is getting ahead of itself. I mean, everything we're seeing from all these deals as well, it does seem very circular in nature. So one could very much make the argument that, yes, maybe we are at the top of the cycle. Does it have more room to run? Probably. But I guess we're getting to the point now of the cycle where, yes, the markets might still continue to grind higher, but you're probably going to see a lot more volatility going forward as markets continue to price in this positive news flow. And as soon as these companies start missing expectations, you are going to see a potentially significant risk to the downside. But yeah, at this point in time, it very much seems that it continues. And then I think also coming back to the government shutdown and the release of data in the US markets, participants are are not only looking at the valuations, but given the extended nature of these valuations, they're kind of hoping for these liquidity injections into the market
Yes.
from the likes of the Fed and the Federal Reserve
Okay, fair.
to continue providing those structural tailwinds to the market so that they continue to grind higher.
All right, let's bring it back home before we move over to the stock picks clips. Equitas out with interim results, upbeat showing from both their SA and UK portfolios, and that, of course, boosting the distribution per share. What have you made of those numbers? I see that the share price is trading in the red. Are markets just not excited about the numbers, disappointed about those numbers?
I think it's more the latter, to tell you the truth. I mean, if we look at, it might be quite impressive that they had the 3.8% growth in the dividend, but the reality is it does fall short of their guidance of 5 to 7% growth.
Okay.
So yes, missing expectations on that front. And however, they have maintained that guidance going forward. So, I mean, if we look at their property valuations, those are up 4% in 6 months as well, which has led to some NAV growth of just shy of 3%. But yeah, I mean, we are cautious on this one because of the cash flows that don't quite cover the dividend. So if we look at cash flow from operating activities of about 388 million rand, that is a little bit short of the dividend of 667 million.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
I'm reusing my stock pick, but for a very good reason, because they're actually bringing out results tomorrow. And I think that'll be an interesting one. That's one of my tech guys back in the office looking at it, and he gets really excited on a technical basis. So it does look interesting. And I think if a surprise comes through tomorrow, and some of these analysts are getting a little bit more upbeat on some of these luxury goods, LVMH relative against its historic PEs is not looking expensive. It has always been a high PE, or call it a high growth type of stock or quality stock. I do think watch this space. If the results come out better than expected tomorrow, don't be surprised this company flies.
Essentially, what these give you is a fixed coupon in return for taking on some equity market risk and some credit risk. So the coupon at the moment we're pricing at 12% in US dollars, which is you're probably looking 3% above the long run average of the S&P 500. It links to the S&P 500, the Nikkei, and the Euro stocks. And as long as all of those indices are positive at an observation date, there's 9 observation dates over 5 years, you'll get that 12% US dollar coupon. It's fully offshore as well. And I think the reason that I'm looking at it at the moment is we've got markets at record highs here, in locally and offshore. Offshore driven totally by this AI boom. You strip out, kind of the Mag 7 and things are looking a little bit shaky. The Mag 7 starts to shake, you could easily see a pullback in global indices. At the same time, the South African market, Skulk was talking about it earlier, it's driven by the precious metals, also can be very, very shaky. So if we go through a period where we do see sideways or flat markets, let's say that we get a 20, 30% pullback at the index level, and it takes 3 years to recover. If you've invested directly in those underlying ETFs, you're essentially going to be flat over 3 years, where this you would get a simple interest coupon of 12% in US dollars.
So Gary betting on markets with the triple index auto call. Skulk, in the meantime, betting on luxury with LVMH. Your thoughts around those picks?
Yeah, maybe to start with the triple index auto call. I mean, it's not something that we do. We are hedge fund guys who pick stocks on a fundamental basis. As well as we have a short book that provides that downside protection he talks about. So look, I do hear the valuation argument and that worry of market concentration across the board. But I mean, outside of developed markets and the US in particular, we continue to find attractive opportunities in emerging and frontier markets. And then looking at LVMH, super high quality business that, on a relative basis is trading quite cheaply. Look, over the last 2 to 3 years, the investment case has derailed somewhat as performance has weakened across most of its divisions, and that's reflective in the valuation. So, I mean, this is all on the back of lackluster growth in Asia and China in particular, and we kind of always asking this question, when is the Chinese consumer going to bounce back? They've just come back from Golden Week. We have seen increases year on year across the board, but at the same time, still only about 2.6% below pre-COVID levels. So that recovery story might be happening, but It does seem to be going at a bit of a slower pace. Yeah, look, I mean, the analysts on the sell side do seem to be getting excited about it now.
And that slump in consumption in China has really dragged. Who would have thought? Really, who would have thought? Before I let you go then, Jason, where are you seeing opportunity at the moment? What's your stock pick?
My stock pick is Mandarin Oriental, one I've picked previously, but we have had some new news on it. So since we last spoke, there has been news around their property in Causeway Bay. So it's a non-core, currently non-income earning as well, real estate asset in Hong Kong. And Alibaba is reported to be in talks to purchase 13 floors, which is just under half the building, sorry, for $900 million. Which is a third of the company's market cap. And the company is also in the process of monetizing its other hotel properties, which on their own are worth about $2 billion, or almost 3/4 of the company's market cap. So with little need for cash, most of the proceeds will be returned to shareholders. And basically what this means is you are paying less than zero for a fast-growing capital-light, high-margin hotel management business and one of the world's best luxury hotel brands out there.
All right, let's leave it there, Jason. Thanks so much for your time and joining us this afternoon. Now, that was Jason Horn from Steyn Capital Management.